The market-based approach is going to tell you what the market is willing to pay for the business based on similar businesses and what they sold for. You're going to use seller discretionary earnings in this case because that the business doesn't have to necessarily be ran the way that it's currently being run. Similar businesses might not use those same exact line items and might not have that same discretionary income, but still are profitable. So seller's discretionary income is going to be used in a market-based approach. Now, discounted cash flows is future-based. It is saying as the business sits under its new ownership, this is what the business can do. It is discounted cash flows. It adjusts for risk. Now, you're not going to use seller discretionary earnings in a discounted cash flow situation because you have a hurdle rate. Like, for example, there's a 22% risk rate in these types of businesses that the discounted cash flow method accounts for. Well, we would be double counting if we use seller's discretionary earnings in the discounted cash flow model, that valuation. So we don't use it. We use net income. We're looking at the business as it sits under new ownership based on its future performance. So we're going to use net income as opposed to seller's discretionary earnings. It's two completely different metrics. One is future-based, that's discounted cash flow. One is market-based, that's based on what similar businesses are doing. It's just two different vantage points to get an idea of value from multiple vantage points. It's the smartest way to assess how a small business should be sold.